$121,500 in student loan debt, $58,000 salary, monthly payment $1,315. Meet Sarah. She's 26, has a master's degree in marketing, and the math on her student loans is getting worse. Her loan balance is growing, despite making payments every month. If you've ever felt like your degree trapped you financially, this one's for you. Sarah Chen, 26 years old, Seattle, junior marketing coordinator making $58,000. She takes home $3,400 per month after taxes. Total student loans, $121,500, bachelor's plus MBA from a private university. Current savings, $800. Credit card debt, $4,200. Her standard student loan payment, $1,315 per month. That's 38% of her take-home pay. Here's where that $3,400 goes. Rent, $1,200. Student loans on income-based repayment, $385. Car payment, $285. Car insurance, $165. The rest, groceries, gas, utilities, phone. Total, $3,865 per month. Take home, $3,400. She's $465 short every month. So she switched to income-based repayment, dropped her payment from $1,315 to $385. But at $385 per month, she's not covering the interest. Her loan balance isn't going down, it's going up. After 2 years of payments, $9,240 paid, her debt went from $121,500 to $126,800. She paid almost $10,000 and now owes more. This isn't about being irresponsible. Sarah did what everyone told her to do. Bachelor's degree, $35,000 in loans. Seemed manageable. Then, you need a master's. You'll make more money. 2-year MBA, $86,500 in additional loans. Her first job after grad school, $52,000. Now, $58,000. The degree gave her maybe an extra $10,000 per year, but the debt cost is different. If you're thinking, wait, I might be in something similar, I created a free 3-minute assessment, same framework I use for every episode. Link in the description. Now, the 3 specific mistakes that got her here. Sarah made 3 decisions that seemed reasonable, but each one created a trap. Let's go through them. Trap 1, the degree debt decision. Sarah borrowed $86,500 for an MBA. But here's the calculation nobody helped her do. On a standard 10-year plan at 6.5% interest, she's not paying back $121,500. She's paying back $177,800. That's $56,300 in interest alone. But she can't afford the $1,315 monthly payment, so income-based repayment. Payment drops to $385. Here's the problem. Her monthly interest is $660. Her payment is $385. The difference? $275 gets added back to the principal every month. Every month she makes a payment, her debt grows by $275. This is the degree debt trap. You're making payments, and the debt is growing faster than you can service it. Trap 2, income to debt mismatch. Rule of thumb, your total student loan debt shouldn't exceed your first year's salary. Sarah's debt, $121,500. Her salary, $58,000. That's 2.1 times her annual income. With this mismatch, the standard payment takes 40% of take-home pay. She physically cannot afford it. So she's on income-based repayment for the next 20 years. After 20 years, maybe $80,000 gets forgiven, but that forgiven amount counts as taxable income. $80,000 forgiven means a $20,000 tax bill when she's 46 years old. The mismatch isn't just about monthly cash flow, it's about a lifetime of constraint. Trap 3, the foundation delay. Sarah is 26. This should be the time she's building her financial foundation, emergency fund, retirement savings. Instead, every extra dollar goes to managing debt. Her $800 in savings covers maybe 2 weeks if something goes wrong. 1 car repair, 1 medical bill, and it's on the credit card. Her $4,200 credit card balance came from car repairs, being in a wedding, emergency dental work, months where expenses didn't fit. She's 26 and can't take career risks because she needs stable income for loan payments. By the time her loans are manageable, age 45 to 50, she'll be decades behind on retirement savings. The foundation delay isn't just about money today, it's about every financial goal being pushed back 20 years. Pattern observation. I've analyzed dozens of student loan situations. Here's the pattern. People borrow based on the degree's prestige and promised earnings, not actual salary data for that field. They don't calculate total repayment cost. They think about the degree, not the debt. And income-based repayment, designed to help, enables the debt to grow. It feels like relief, but delays the problem for 20 years. Sarah isn't alone. This is the most common trap for people under 30 who followed the invest in education advice. What can someone in Sarah's situation actually do? I'm not telling you what Sarah should do. I'm showing you patterns that tend to work. Pattern number 1, strategic repayment. Standard payment, $1,315. Income-based, $385. That's a $930 difference. The pattern, $300 to kill the credit card debt first. That 22% interest is wealth destruction. $200 to build a $3,000 emergency fund. $200 as extra principal on highest interest loans. And $230 to actually live. Credit card gone in 14 months. Emergency fund built in 15 months. Then all extra money attacks the loans. Pattern 2, income acceleration. At $58,000, Sarah's income is the real constraint. People who escape this trap focus less on cutting $50 from groceries and more on increasing income by $10,000. What works? Aggressive raise negotiation every 12 to 18 months. Job hopping every 2 to 3 years for 20 to 30% bumps instead of 3% raises. Side income in their skill area. Freelance marketing can bring $500 to $1,500 a month. Relocating to higher paying markets. Even an extra $1,000 a month changes everything. That's $12,000 per year going to loans, cutting the 20-year timeline to maybe 8 to 10 years. Pattern 3, forgiveness planning. Some people stay on income-based repayment intentionally and plan for 20-year forgiveness. They work for qualifying employers when possible. Public service loan forgiveness cuts it to 10 years instead of 20. Here's the unconventional part. They invest extra money instead of making extra loan payments. The logic? Loans are at 6.5%. If you're paying for 20 years anyway, putting extra money into retirement accounts earning 8 to 10% might build more wealth than accelerating payments. Mathematically, sometimes accepting the long timeline and building wealth alongside it makes more sense than sacrificing everything to pay loans faster. The key is planning for that tax bill in the forgiveness year. Here's the reality. You need to understand Sarah followed the advice everyone gave her. Invest in education, get the degree. But the cost of graduate education went up 150%, while starting salaries went up 20%. That math doesn't work. Sarah's trapped, but the trap has exits. They're just slower than anyone told her. The difference between Sarah and Marcus from last week? Marcus can cut his rent tomorrow. Sarah can't reduce her student loans tomorrow. This is a decade-long strategy, not a 6-month fix. But she's 26. If she focuses on income growth and strategic repayment, she can be financially free by 36. That's still young. Next week, a 35-year-old who just realized they have zero saved for retirement. The math gets interesting when you start that late. Subscribe so you don't miss it. Drop a comment. Which trap hit hardest? Number 1, debt growing despite payments. Number 2, income to debt mismatch. Number 3, foundation delay. Just the number. Assessment link in the description. 3 minutes shows you which trap you're in. This is Financial Reality Check. See you next week.